Welcome to the Explainer. So let's jump right into this, because today we are looking at a completely fascinating paradox. We're currently in this market environment where so many indices are just flying high, right? Everyone seems to be making an absolute fortune. And yet, one of the most successful market analysts out there is doing something totally unexpected. We're talking about Florian Grummes. This is a managing director who correctly nailed gold's multi-year breakout and literally called Bitcoin's early timeline to a T. But right now, he is stepping back, way back. So today, we're going to unpack his strategy, looking directly at the data and insights he shared in a recent sit-down on Miles Franklin Media. Let's find out exactly why a seasoned pro is pulling his chips off the table during what's supposed to be a massive boom. Well, Grummes isn't mincing words here. He is actively preparing for the possibility of a truly catastrophic market event. When someone says this could be a crash like 2000, where the market pulls back 50 to 80%, we're not talking about a simple everyday correction. That is a wealth-destroying event, totally on par with the bursting of the dot-com bubble. So, as you can imagine, this sets the stakes incredibly high for what we're going over today. And to shield himself from that exact nightmare scenario, Grummes is sitting on a massive, massive number, 50%. Over half of his entire portfolio is sitting in cash liquidity right now. What's really wild about this is that it represents the absolute highest cash position he has ever held in his entire career. While the rest of the market is out there enthusiastically chasing the rally, he is quietly building a fortress of liquidity. But you've got to ask, why? Section 1, the AI stock market bubble and the confetti party. Okay, to really understand that 50% cash pile, we have to look at what's driving his anxiety about equities. It basically boils down to two massive forces: a wildly overheated tech sector and a macroeconomic backdrop he likes to call the confetti party. Grummes draws a really direct parallel between today's artificial intelligence boom and the late 1990s dot-com bubble. Think back to the 90s. We saw massive investments building out the internet's infrastructure, right? But the stock market totally crashed long before we actually started using things like Amazon every single day. He argues the exact same thing is happening right now with AI. We're funding the infrastructure today, sure, but the realistic timeline for everyday robotic integration, that's probably 10 to 20 years out. So, in the meantime, he's expecting a huge, painful market disappointment. And here is the specific data point that truly alarms him: 330%. That is the absolutely staggering parabolic rise of the SOXX semiconductor ETF over a recent 14-month period. Look, Grummes points out that this kind of chart is simply not healthy. The air is incredibly thin up there. And while Wall Street is aggressively pushing this euphoria, other ventures, like the heavily hyped retail IPO for SpaceX, have completely struggled right out of the gate. There is this deep, undeniable disconnect between the absurd AI hype and what's actually happening in the broader market reality. So, the crucial question is, what keeps this giant balloon from popping? The answer is fiat money. Grummes refers to the macroeconomic environment we've been in since the 1970s as just a non-stop confetti party of money printing. To put that into perspective, just recently, the U.S. M2 money supply surged by a record $248 billion in a single month. This relentless expansion of liquidity basically acts like this gravity-defying force, artificially pushing asset prices higher and higher and higher. But it's actually not just central bank printing doing the heavy lifting here. Grummes notes that structural market shifts are acting literally like Pepto-Bismol for an overheated market. We have hundreds of billions of dollars flowing on complete autopilot into passive index funds every single month, totally ignoring whether a stock is fundamentally overvalued. Add to this new, large-scale government-funded investment programs for children, which actively mandate investments into these very same index funds, and you end up with this permanent, artificial source of demand. This autopilot buying is just masking the fundamental rot and essentially artificially delaying the inevitable correction. Section 2. Gold and silver's next move, the traditional hedge. So if you're actively avoiding an artificially propped-up stock market, where on earth do you put your capital? Let's pivot over to the assets Grummes has championed for decades: precious metals. Now, despite a recent breather in the charts, his long-term outlook remains incredibly bullish. Recently, we actually saw record-breaking outflows from Western paper gold ETFs. We're talking to the tune of billions of dollars. But rather than panicking, Grummes views these ETF sellers as weak hands. And why is that? Because at the exact same time, physical deliveries on the COMEX reached record highs for June. This is being driven by massive, relentless physical buying from strong hands over in Asia, particularly China. So he reads the paper sell-off not as a death knell at all, but actually as a brilliant, incredibly bullish contrarian signal. Let's break down his specific numbers for gold, because they're pretty eye-opening. Right now, gold has pulled back to around the $4,000 mark, which he sees as a really solid support level, where value buyers are eagerly stepping in. His absolute worst-case downside is $3,500. But once gold finishes this healthy correction and eventually takes out its previous all-time highs of $5,600, his future target is a massive $10,000 an ounce. It's an absolutely incredible number, though he does caution that hitting this 10K target is very much a long-term play. You're going to need about 3 to 5 years of patience for that one. Now, what about silver? Well, silver went on an unbelievable 600% parabolic run from its 2022 lows, hitting a former all-time high of $121. It's currently digesting that huge move, finding really strong support around the $45 to $50 range. And because silver is a vital industrial metal that's heavily tied to the booming data center and AI sectors, its long-term future is looking super bright. But Grummes warns investors that they need to hold their horses here. You likely won't see triple-digit silver again until roughly 2028. Section 3. The Great Crypto Exit. Okay, so we know he's heavy in cash, he's holding physical metals, and he's completely avoiding stocks. But this next part, this features the absolute most surprising revelation from his entire analysis. We are talking about his complete 100% abandonment of a major digital asset class. It brings up a huge question. Why did a massive early Bitcoin bull just sell it all? I mean, Grummes is a guy who accurately called the 100K Bitcoin timeline years in advance. He held physical metals right alongside self-custodied Bitcoin. Yet last October, he liquidated his entire cryptocurrency portfolio. He is totally, completely out. He actually lays out 3 core reasons for jumping ship. First off, over-financialization. He firmly believes Wall Street's embrace of Bitcoin via ETFs has basically stripped it of its original sound money ethos. Second, and this is crucial, the looming technological threat of quantum computing. He views Bitcoin as an old-school technology now, and in a ridiculously fast-moving AI world, trying to slowly upgrade its consensus protocols to be quantum-resistant, it's just going to be too slow. He is simply not willing to risk his own money waiting around to see if they can fix it. And his third reason? We haven't even hit the bottom yet. And that brings us to a very specific concept he talks about, the crypto winter bloodbath. Grummes notes from historical experience that crypto cycles don't just turn around quietly. They turn around amid sheer panic, terrible news, and high-profile institutional implosions, exactly like we saw with the FTX collapse. Right now, he sees low sentiment, sure, but no real panic on the streets. So, until that bloodbath actually occurs and true fear returns to the market, he is happily sitting on the sidelines. Section 4. The Summer of Patience and Mispriced Risks. So, considering all this, how exactly should we navigate it? We've got overheated AI stocks, physical gold rapidly moving to Asia, and crypto facing existential quantum threats. First thing, keep your eye on the one major sector he believes the market is actively mispricing today: oil. Despite some recent sharp pullbacks, Grummes points out that global oil supplies remain incredibly tight, and Western countries have largely depleted their inventories. Because of this perfect storm, he sees a very high probability that oil will quickly bounce back to the $80 mark by late summer. It's a really rare pocket of opportunity in a market where pretty much everything else feels totally overvalued. But zooming out for a second, Grummes paints a really sobering picture of the broader reality. He calls it the K-shaped economy. While the top 1% are out there making an absolute killing, riding the AI equity bubble, everyday citizens, like the taxi drivers he talks to, are really feeling the crush of relentless inflation. That confetti party of money printing we talked about earlier, it is not trickling down. Instead, it's squeezing the vast majority of the population who are just struggling to keep their purchasing power intact. Faced with this K-shaped economy and these wild, volatile markets, his ultimate strategy is wonderfully simple. The best asset an investor can have right now is patience. He strongly advises against forcing trades in an overheated, distorted market. His playbook right now is literally to chill out, let the summer doldrums pass, enjoy the air conditioning, and just wait for the market to come to you. So when does he actually plan to get back to work? Well, his timeline is pretty concrete. For the summer, relax and sit on that 50% cash pile. By late August, the Federal Reserve's Jackson Hole meeting is going to provide some essential clues on interest rates. And then, as we get into September and early October, it'll finally be time to reassess. That's when he'll look to see whether the AI bubble is finally bursting or if the market has digested the summer dip and is ready to run again. Which really brings us to our final thought for today. We've seen Grummes' playbook: hoarding cash, stacking physical metals, completely dumping crypto, and just waiting for the dust to settle. But you really have to ask yourself, in a K-shaped economy that is entirely propped up by a continuous confetti party of fiat printing, is your own portfolio actually prepared for the inevitable reality check? Are you holding weak paper hands or strong physical ones? It's a profound question to leave you with, and one that absolutely demands a deep look at your own risk and liquidity right now. Thanks so much for joining me on this explainer, and we'll see you on the next one.